Welcome. In this video, OnyxCoin broke the pattern. Is a rally coming? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. The descending wedge pattern, which has been observed on the chart for a long time and attracted a lot of attention, seems to have finally made the expected breakout. This type of pattern usually forms towards the end of downtrends and signals a potential trend reversal. Descending wedge patterns are usually formed by prices falling from highs and narrowing into an increasingly compressed structure. The lows and highs within this structure each occur lower than the previous one, but a closer look reveals that the top line is heading down at a steeper angle than the bottom line. This implies a squeeze and an accumulation of energy due to the nature of the pattern. Currently, the price has managed to break the upper line of this wedge pattern. This is a very positive technical development, because descending wedges generally tend to result in a bullish outcome. With the breakout, the price has entered a new phase. This can be interpreted as a strong signal that not only the current downtrend is over, but also that a new uptrend may begin. Of course, one of the most important points in such breakouts is the retest process. The fact that the price is currently retesting the broken upper boundary of the pattern creates a very healthy structure in terms of technical analysis. Because the beginning of a strong trend usually comes with such retest movements. The retest process is a very important stage that gives traders a second chance, especially for investors who missed the first breakout or are looking for confirmation. This region offers a strategic opportunity to enter the market. At this point, if the price confirms this upper boundary as support, it is a strong sign that the trend will continue upwards. If the price manages to bounce off this level to the upside, momentum will increase, and the uptrend is likely to gain momentum. However, this breakout is not only a technical detail, but also an important threshold in terms of market psychology. This is because traders keep a close eye on such squeeze structures and take positions according to the breakout direction. Since structures such as a descending wedge are a sign of a potential rebound even in a falling market, buy orders can be quickly activated at the breakout. This, in turn, leads to an increase in volume, allowing the price to move more strongly upwards. The current retest process is a reflection of this psychological structure. There is an accumulation phase in the market as traders test whether the broken level is really support or not. After this phase, the direction usually becomes clear and the upward momentum gains momentum. It is also useful to evaluate this breakout within the overall market structure. If the overall trend also has upside potential, this breakout and retest can be a harbinger of a major bullish move. Breakouts of such patterns, especially on large timeframes, can affect not only short-term, but also medium and long-term trends. At this point, the size and duration of the pattern are also very important. Breakouts following long-lasting squeezes usually lead to larger price movements. During the retest process after the breakout, candlestick patterns should also be paid attention to. Especially wick candles indicate buying pressure, and the formation of such candles in the support zone confirms that buyers are active in that area. The increase in volume is also very important during this period. If volume falls during the retest and then increases again during the subsequent bullish candle, this is a positive signal for technical analysis. This structure provides technical evidence that the price will continue its upward movement from support. In conclusion, the fact that the price has broken the descending wedge pattern to the upside and is currently experiencing a retest process by retreating back to this breakout zone offers a very promising and positive technical structure. But we cannot decide the analysis only with the pattern. Let's look at other metrics. Keep watching. One of the most notable structures on the chart is the strong resistance zone, positioned on the upper side of the price. This level stands out as a highly critical area that the price has tested several times in the past, but failed to break through. Resistance zones represent areas in technical analysis where investor psychology is embodied and where supply and demand clash. In these areas, sellers usually step in and suppress the upward movement of the price. However, what is noteworthy here is that the price has tested the same level several times. This is an important sign that the resistance zone is starting to weaken, and the price is gathering strength to break it. Looking at the price action, it is observed that in the past, there have been pullbacks every time this resistance level was approached. However, with each pullback, the price has maintained its upward momentum by making higher lows. This shows us the strength of the buyers, and that the price comes stronger every time it comes to this area. These successive attempts to the resistance zone clearly show how the bullish pressure that has actually accumulated in the market has increased over time. The increase in volume and the stability in candle structures, especially in recent attempts, may indicate that the price is no longer looking at this level as a barrier, but as a transition point. In this context, a common principle in technical analysis comes to mind. The more it is tested, the weaker it becomes. That is, the more the price tries the same resistance, the more the level starts to lose its durability over time. The main reason for this is that most of the traders who sold at the resistance zone have already executed their sell orders, and the new selling pressure becomes insufficient. On the other hand, most of the traders watching this area are prepared to buy, thinking that if this resistance is broken, the price will go even higher. Therefore, the moment of the breakout often creates a burst of momentum and causes the price to shoot up quickly. If the price manages to break through this resistance level, it will not only be a technical level crossing, but also a psychological threshold. With a break of resistance, traders who previously sold at this level or thought that the upside would be limited may reconsider their positions. This may increase the buying pressure with the FOMO effect and cause the price to move much higher. Also, with the break of the resistance zone, this level will now turn into a support position and will work as a strong support when the price subsequently retraces back here. This allows the uptrend to continue in a more sustainable and stable manner. A break of the resistance level can also create new opportunities in terms of technical patterns. For example, if there is a triangle, pennant, or narrowing wedge pattern formed just below this level, the break could activate the targets of these structures. These targets are usually located above the height of the pattern and give us an idea of how high the price can go. At the same time, these resistance levels, which intersect the channel or trend lines, allow technical traders to get a clearer direction after the breakout. Increased investor expectations for this resistance zone are reflected in the order books. An increase in buy orders can help increase liquidity and support the upward movement of the price. In addition, such breakouts may also be on the radar of large funds that make algorithmic trades, because many algorithms use breakouts at certain levels as signals to open positions. This can lead to buying pressure from a wider investor base and accelerate the rise. Another important factor to consider when a breakout occurs is the trading volume. Breakouts with volume are usually more persistent and move the price steadily upwards. Volumeless breakouts, on the other hand, can often be what we call fake breakouts. One of the most notable technical indicators on the chart, the 200-day exponential moving average, is a highly reliable and widely used analysis tool that allows traders to get an idea of the long-term price direction. The relationship of this indicator to price is invaluable in understanding the overall trend of the market. In the current outlook, the fact that the price is positioned above this 200 EMA level indicates that the overall market trend is upward and that the bull market is dominant in the long term. In technical analysis, this indicates that the price has a positive bias and has the potential to test higher levels in the coming periods. Since the 200 EMA is calculated by taking the exponential average of the past 200-day closing prices, it is considered a long-term trendsetter, especially by large institutional investors and professional traders. Therefore, as long as the price is trading above this level, market participants generally consider the uptrend to be valid. This also suggests that the price is not just in a temporary rebound, but is in a permanent uptrend. Therefore, the fact that the price has managed to stay above the 200 EMA in the current structure is a very important development that restores investor confidence and shifts market sentiment in a positive direction. The 200 EMA helps us to see long-term trends. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.